Hello everybody, I'm L.A. Little. This is a weekly review that I typically do for members. And speaking of members, I want to talk about membership real quick and then go into the video. I know that it's a burden for people to come up with the money to pay for subscription. And you know, subscription is not exactly cheap. And I understand that. I also understand these are unduly difficult times with what's going on out there in the markets. I continue to do my job with professional subscribers, primarily in Europe, a lot of hedge funds, large fund managers, and a lot of my time is spent there, but I continue to do my work to try to help small subscribers. That was always what I wanted to do, and I wanted to help to show anybody that they could do this themselves and to give them guidance with respect to that. So one of the ways to do this is to take this membership fee and try to bring it down. And the idea here is that you can bring up to 10 friends, $100 each if you did 10, group together, right? Share this video, get a group together, come over to the TAToday site, register each one of those friends, all of them register, and once they're all registered, just send an email, send it to support@TAToday, and list all the members and say you want to take advantage of this new subscriber membership. And it's going to be for some limited period of time. I haven't decided when, but it starts today. So if you want to get some folks together, cut your membership cost down, you can get a full year subscription, right? All of the material that I provide, all the tools that are available to you, and the ability to learn a neoclassical model over time. All of that, right, for a very low cost. You can bring 5, you can bring 3, however many friends want to come together, take this, divide it by whatever the number is, and that would be your cost for a full year subscription. So take advantage of it while it's there, and you can get all my material live and up to date. And of course, if you can't do that, you can always get 2 years just by registering on the site here. You can get 2 weeks delayed data. You just won't be able to get to the tools. Let's talk about these markets, where we're at. Now, you can visualize what's happening, right? The market climbs, 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 gets a bounce, comes up, and then just takes a dive, right? And so you end up down, 30+% or so. And that's kind of where the markets went. And you had this one chance to escape. And if you go back and look at the material, and it's even available on the site now, even if you just register and look back at it, I was telling folks, get rid of some of your long positions here, lean down, right? Prepare, because this could get ugly. And the reason for that is we had the setup that can get very ugly, and that setup is something you always protect against. Well, not only did you have to protect against it, you had to try to protect everything against it, because this is one of those, once in a decade kind of things where, the bottom fell out of this thing. And that sometimes happens. This week, huge bounce. And so you get this big plunge, right? Big bounce off of it. Now the question is what happens after this? So year to date, still big losses. Dollar was down, everything else was up. The dollar was screaming higher before and everything else was down. Think there's a relationship there? Yeah, it is. And so the dollar is a key thing to keep your eye on. As far as the rest of these markets, they all bounced last week, except even though they bounced, you're still down massively, right, year to date. And this kind of technical damage is not going to be solved in a short period of time. So let's start with the big picture. The long-term trend is changing. Here's a swing point low, and if you don't understand the neoclassical model, you can go pick up some of my, my books. And there's a couple of them out there that'll help you. You can come over to the site. You can ask, log in, contact us. I can direct you to things on the site itself. There's some material that you can read, some videos you can watch. But if you don't understand it, start to understand it, because this model is invaluable to keep you out of trouble. It kept me in 2008 from losing a lot of money. Matter of fact, I made money in 2008. It was up about 6+% that year. This year, personally, and for those people that I manage, here in the States where I money manage, and if you're interested in that, just contact me. But right now they're down about 1%. If I look over at the hedge funds and the fund managers that I advise on a professional level, they're up anywhere from 30% right now, right? And that's the best one. And the worst one's up about 7%. That's in this kind of a market. Folks, the neoclassical model will help you stay on the right side of the market. It's all about trend, it's all about timing. So anyway, getting back to trend here, things gonna break a swing point low, wants to go lower. It already came all the way down and almost tested back into these swing point highs. That's a retest regen. The odds of that breaking are higher than it is for holding. So if we get down there and test that, there's a good chance it's going to break, and if it does, it's going to head back to the high of the low or the lows themselves, and that's anywhere down around 2,000 down to about 1,800. So a long way to go if this thing breaks. We're sitting up here at 25 plus now, and you know, even 500 down is a big move. What's it going to do now, right? Well, first of all, trend's changing. When trend changes on the long term, that's usually not a good thing. This thing's been an uptrend for a very long time. If it in fact goes to a downtrend, which would be a break of this swing point low, so in other words, we close under 2340 or so, I think it is, which was the lows of December of 2018. You close underneath there on a monthly basis, then you're going to change to a bearish trend. So we're going to go from bull to sideways to bear. That's the way the market works in the neoclassical model. Now, what led me to tell folks, you know, get safe, was not only did we have this swing point low that broke on that first move down. Remember I talked about a move down and then the bounce? I told folks to get out on that bounce, and we almost called it perfectly in terms of where it went to. That bounce was your kind of your escape valve, and almost always the market gives you an escape valve. And so we got that bounce, but what we were looking at, the reason we were calling that bounce and saying we needed to get out there, was because we had all these swing points located fairly congruently, right? They were about a 200-point period, and we just dropped more than 200 here, so we knew it was quite possible to break them all. And that's why we said, you know, you got to get safe. You got to be prudent and get safe, get liquid, so that if this does do what we think it might do or could do, you'll be all right. And of course that is what it did. So multiple swing points breaking on multiple time frames. That says, and that's what's happening, will happen as of, on the monthly, will happen as of Tuesday. That says that you've got to expect 2 to 3 bars sideways on the longest time frame, which is that monthly time frame. And so you've got to expect this is going to travel sideways to down, right, over the next couple months at a minimum. So that's where we're at. So speaking of the short term, right, if we look at it, there's actually 2 or 3 things going on here. Primarily, you've got these ABCD structures now that are set up to try and push to the 2218 to 2143 levels. And you know, we could talk about the ABCD structures and how those work, but you know, just suffice to say that those 2 are set up. Notice that those, the intersection of those is in here in a test of the lows that we just saw a week ago. And so I would expect that this market's going to try and roll back over, and you know, there may be another test to try to go high, and if it does and fails, then you'll get a faster move, or we may just dribble down there. But somewhere over the next week or 2, I would expect this to happen. And when it happens, it's going to set up probably an opportunity to buy this and move back the other way. Now, we'll have to judge it when we get down there. We'll have to decide what it means, and if in fact it's going to take place and we're going to get a nice bounce off of it. The ideal thing would be to get underneath here. Volume just dries up, right? And then you shoot back to the upside. If that happens, remembering back what we just said about the 2 months, you know, this market, again, I don't think it's shooting back up to here. It's coming back up maybe to where it was, maybe a little bit higher, maybe some of these other levels, and we can talk about those in future videos, in future mailings that we do. But if it does start to come back up, it will test those areas and attempt, right, to recapture more of these gains. I suspect, though, from what we've seen on the longer term time frame, right? We're in at least a sideways and potentially a bear market. So I wouldn't get too optimistic, and that's despite everything that the Fed and the fiscal stimuluses are trying to do. So that's where we're at. Finally, I just want to remind you, right? If you want to be a subscriber to TAToday, this is a limited time period, right? Usually it's $1,000. Gather up to 10 people together, cut your cost down, way down, right? For a full year subscription. Get this information live, you know, from a professional who teaches professional and provides advice to professionals, as well as to non-professionals, professionals such as you. So give me a holler. Just get it together, contact support, and we'll get you started. Have a great one. Take care. Be safe out there. This is nasty virus that's attacking any and everyone that it sees. Take care.